Hello everyone, welcome to this video. My name is Mohammed Rahim, and in today's video I'm going to discuss what I like to call my secret millionaire studies. Right? It's about a gentleman named Ronald Read. This was an actual gentleman. This was an actual man who lived in Brattleboro. I think it was Brattleboro, Vermont, right, in the US, and he died I think in 2014 or 2015. I think it was June 2014, right? Because and he died when he died. He had a lot of he had basically acquired stocks worth $8 million, right? And the interesting thing is that the gentleman, whose name is Ronald Read, was basically throughout his life he basically worked as an attendant at a gas station, or he worked as a janitor in a JCPenney store, right? So point being that he was never making a lot of money, but by being living a frugal life, and by being disciplined at saving and investing, and of course learning the craft of investing, right? Stock investing, is basically he was able to acquire approximately $8 million when he passed away at the age of 92, right? I think it was the age of 92, yeah. So that's basically, so I hope that's something which sounds interesting to you guys. I'm going to dive a little deeper into this case study, and the idea is basically to share with the audience, especially my younger audience, since I teach university students as well as CFA candidates. I basically help them prepare for their final exams. So the idea is to help them get a head start of everyone else, right? Now, how you might be wondering as to how he did it, especially since he wasn't making a lot of money. He did not make a lot of money throughout his life, but I'm going to go into that, right? And of course, we're going to talk about compounding, which Einstein used to call the eighth wonder of the world. And of course, Ronald Read, basically that was his secret weapon, right? Compounding. He used compounding as it was his weapon of choice, when it came to investing, and it did wonders for him, right? Now, let's just dive into it. And to give you guys a quick background, I have my notes in front of me, of course, and to give you guys a quick background on Ronald, he basically passed away in 2014, right? I think it was June 2014, when he was 92 years old, right? He died at the age of 92, which is basically an interesting point to note, because he basically got a lot of years of compounding, right? That's one reason why he was able to acquire so much wealth, right? Because he compound. That's the nature of compounding. If you and this is an interesting exercise which you can do, that if you, let's say, take just $1,000 and if you compound it for let's say a rate of 12% per year, right? And you compound it for 20 years, and then you take the same number, that is $1,000, and you compound it at the same rate, 12%, and you do it for 30 years. The numbers are going to be quite different. So just to run the numbers myself, if I take $1,000 and if I invest those for 20 years at the rate of 12%, right? Then after 20 years, that amount would be worth $9,640, right? About almost $10,000, right? However, if I change the compounding, if I change the year from number of years from 20 to 30, then that becomes almost $30,000, right? So although it's just 10 more years, but the ending the consequent wealth is basically 3 times as much, right? Although the number of years went up just 1/3, however, right, because from 20 to 20 years to 30 years, but the wealth compound went up by 3x, right? So that's basically the power of compounding, and this is something which is an interesting exercise which I used to do when I was younger. I would basically take, I would just I had gotten this I learned how to use the financial calculator, and I learned how to do these calculations of present value, future value, and I would just sit there and just think about, if I start with like $1,000 or $2,000 or $5,000, right, and this was back when I was in my early 20s, and if I invested at an average of 12% per year, right, and of course this number is going to vary. The rate of return is going to vary based on the market in which you are. In which you're going to be investing, but 12% for the market that I'm in, that I think that's a pretty reasonable annual return. I think that's a reasonable calculation, and so I would basically see, if I invested $5,000 for 20 years, how much would I have at the end of those 20 years? Then I would just change the years, right? Sometimes I would also I would keep the number of years the same. So, for example, I just I wouldn't change the number of years. I would just keep it at 20 years. But I would say, what if I was able to compound at, instead of 12%, I was able to compound at 15%. And, doing this, and you would see that the numbers the ending results would be massive, right? One tip that I would like to give is that basically the longer the time period, right, and the higher the rate, that of course, that's the way compounding works. I'm sure most of you are aware of this, but if you just play around with those numbers, you are going to you're gonna experience, you're gonna see something magical. It's just amazing the way compounding works, right? And so that's something which I would do. And coming back to Ronald Read, it's basically Ronald had basically about 99 decades behind him, right? Let's say, and although and by the way, this case study, you can research it online. It was in an article, right? It came out in Ronald Read's case was there in an article in the Wall Street Journal. I'll link it in my video description below, so you can reference it for yourself if you're interested. So the point being that Ronald basically started at a young age. He started investing at a relatively young age, and he went on to live a relatively long life, and that's one of the reasons why he was able to accumulate so much, right? Even with such even despite not making a lot of money throughout his life. So that's the first point. Now, just to give you guys a quick background on Ronald Read, that's basically he was from Brattleboro, Vermont, right? I think Brattleboro is a small town in Vermont, USA, right? And he had no college education, right? And he drove a Toyota Yaris, right? And always made a point of living below his means. Now this is something which I highly encourage, right? It's something which I used to struggle a lot with, living below my means. But this is something which, if you are interested in making a lot of money, or ending up with a significant amount of investing with capital, with a significant amount of capital, it's highly recommended that you are basically frugal in your living. Right now, it's not necessary, because it might differ from person to person. But if you are like most people who do not have a lot of who do not come from wealth, right? Of course, if you're a trust fund baby, then that's something which won't apply to you. You can you can spend and still invest, right, depending on your available resources. But for most of us mere mortals, right, so it's basically who do not have a lot of available cash. And I'm basically here to tell you that you can still end up with a significant amount of money if you are intelligent with your investing, and if you're disciplined and intelligent with your investing, right? It might require you to stop trying to keep up with the Joneses, right, as they say. Stop buying those those expensive watches and those expensive suits. Once in a while it's okay to do such things, but if you are like most of us who do not have a lot of resources and you want to acquire a lot of wealth, then you will have to save, right? You will have to earn and save, right? So anyway, coming back to Ronald Read's case, his background. So the gentleman basically spent many years working at a gas station, right, as a gas station attendant, and the rest of his career as a janitor at his local JC Penney store, department store, right. So again, this is something which I mentioned before, but it's something which is very important to note, that he was not making a lot of money. And still, despite that, he was still able to accumulate such a large amount of money. Now, another interesting thing is that something I'd like to point out is that Read was a near perfect archetype of the academic research done by men like the late Dr. Thomas J. Stanley, right, and Dr. Jeremy J. Siegel, right? These two gentlemen, they were basically professors in different U.S. universities. I think Thomas Stanley was at the University of Georgia, and Dr. Jeremy Siegel was a Wharton professor, right? So these two gentlemen, they did some research, and which basically said that. Excuse me, which basically stated that the majority of the Americans who are the top 1% of the wealth, right? These are people who have acquired, who have not inherited the money, but they are actually first generation wealth. It's basically first generation wealth, right? In other words, these people were self-made, and they made it for themselves, for themselves, right? Their parents or their grandparents did not inherit the money, which is something which is very interesting, right? And so another interesting point about Ronald Read was that he was basically very stealthy about things, right? He practiced what's called stealth wealth. Okay, stealth wealth. Stealth wealth is basically where these people mostly keep their money a secret, right? From even their own children and friends. Okay, so this is something which is very interesting, and you'll see. You might not realize that a lot of people practice it, but it's true. You might come across people who are very, you might seem to be, who are living a comfortable life. You'll see these people living comfortable lives, and you might say, yeah, he's comfortable, but you might not realize as to how much money they actually have, right? Because they choose to practice stealth wealth, right? They could. I know quite a few people who who could easily afford, who could really afford to upgrade their lifestyles without any problems, right? But they choose not to, right? Because they do not want to they don't want to attract unnecessary tension, or because then it has its there are some issues around, and people coming to you asking for money, and so that's something which a lot of people choose to practice, right? And that's something which I would advise you guys to practice as well, right? Because it's a smart thing to do. But anyway, so Ronald was pretty stealthy about his wealth, right? Keeping his money secret from even his own children and friends, right? Now they knew his loved ones, close people close to him, and the loved ones. They knew he enjoyed investing, but they were reportedly shocked to discover upon his death, that he had a safe deposit box with a stack of stock certificates 5 inches thick. Okay. So because back in the day, people would although now it's mostly gone digital. You don't get those physical certificates, although you could still get them if you wanted to. It just costs a little money. There are a few charges around that, but you could still get those physical stock certificates. But back in the day, early in the day, most people would have physical stock certificates, right? So his on his death, people found when his assets were disclosed, right, to his family, they were shocked to find out that his stock certificates were 5 inches thick. Okay, that's a lot of stocks, right? So now to continue with Ronald's background, please note that the 5 inches thick stock certificates, stock certificates. In addition to that, there were nearly a dozen and a half direct stock purchase plans, direct stock purchase plans, in which he had enrolled via electronic registration to take advantage of the lower costs, right, that were offered, right. So basically, so what the point being that the stocks, the 5 inch thick pile of stocks, that was not just the end of it. There were quite a few investments stock purchase he had made, for which he did not have stocks, for which he did not have the stock certificates, which is pretty cool, right? Because that's a few more zeros added to his wealth right there, right? So now I'm gonna tell you guys about his largest stock positions, right? Basically, he had approximately $510,000 in Wells Fargo and Company. Okay, Procter and Gamble position was around 364,000 USD. Okay, please note that these are all. This is back in 2014. So the inflation adjustment you might have to take care of the inflation. If you wanted to see how much that money is worth today, we would need to make a few adjustments for inflation. But still, and of course, today these stocks should be worth a lot more, right? Because he passed away in 2014, and this was these records are from back then, right? So today these stocks would be worth a lot more. Now coming back to his largest stock positions. So first was, of course, Wells Fargo and Company, worth $510,000. Procter and Gamble was $364,000. Colgate Palmolive was $252,000. Okay, American Express $199,000, right? And I'm of course rounding the figures off there. Like for example, American Express, I said $199,000. It was basically $199,034, right? Colgate Palmolive, which I said $252,000, was actually $252,104. So I'm rounding the numbers off, right? For the sake of simplicity. Now, J.M. Smucker was around $189,000. Okay, Johnson and Johnson won $83,000. VF Corp, okay, $152,000. McCormick, I think McCormick is it's a manufacturer. It manufactures spices, right? It's a highly profitable business. It's a great business, very high returns on capital employed, right? Very high cash flows, because their reinvestment needs are quite low. So that was another big position in his portfolio. Raytheon, right? 142,000. United Technology, 140,000. Right. So these are basically his largest stock positions, right? As reported in the Wall Street Journal. Now let's get to the interesting part. So how did Ronald Read get so rich, right? That's the. I'm sure you all have the question. We're all thinking, how did he get so small? How did he get so rich? So first of all, he started small. Okay. Now remember that according to the Wall Street Journal, it was mentioned that the trades, Ronald's trades, they went back to the 1950s, right? And they began quite modestly, right? In other words, the investments he was making back then, they were not very big sums from any standard, right? But they provided one illustration. But to provide you with one illustration, it's basically on January 13, 1959. When he would have been around 37 years old, okay? He bought basically 39 shares of Pacific Gas and Electric for $2,380, okay? And the article went on to state that the trade within inflation adjusted total was around $19,200 or so in today's purchasing power equivalent. Now, please note, one thing I'd like to point out is that I read this article in 2015, I think, right? This is a long time ago. Came across this article, and I by the way, I keep going back to it from time to time because the message is just so it's just so powerful, right? And I enjoy reading such articles, because it gives me it drives me, because although I with experience I've learned that I've experienced a lot of things firsthand, but back then, back in 2015, I had not experienced so much I had not seen so much. So seeing other people, it just made me aware of the possibilities, right? And so I just really enjoyed going through the articles. But anyway, coming back to the point is like back in 2015, the inflation adjusted amount was around $19,200, right? Which that was just basically 39, which was basically 39 shares of Pacific Gas and Electric Company, right? Electric he had bought for two. So basically, in 1959, when Ronald was 37 years old, he bought 39 shares of this company, Pacific Gas and Electric, for $2,380. And then when he had passed away in 2015, right, when the article was written, was basically when the amount had turned to $19,200 or so, right, in today's purchasing power equivalent, right? So please note that this is not I'm not saying that the position for Pacific Electric Gas and Electric grew to be $19,200. It's just saying that the trade which was done in 1959 for $2,380 would have been worth $19,200. So if someone wanted to make the same investment, right, in inflation adjusted terms, they would need to put in $19,200 in 2015, right? Today that amount would be even bigger, of course, right? So continuing with how did Ronald Read get so rich? He also spent 60 plus years quietly, patiently, and regularly accumulating equity in some of the most successful businesses in the world, right? Across a wide range of industries. So he was quite well diversified as well, right? So he had diversification, and again, 60 plus, give or take a few years. He basically, the point being that he had a lot of decades, like 6 decades approximately, give or take a few years. He basically had to grow his money, right? To compound his money. Now he owned railroads, banks, credit card companies, industrial conglomerates, dish, soap, and toothpaste empires, packaged food giants, you name it. He had it, right. What's important to note is that multiple times this is something which people don't realize. There is that even if not even, it's just facts. If you go and look at the like the investor, the financial market, specifically the stock market, it's been through massive ups and downs, right? Fluctuations throughout those 60 plus years, through which specifically when we talk about Ronald over here. So he experienced a lot of ups and downs in his stock portfolios. Okay. Sometimes the declines would have been around 50% or more, right, on paper. But he just plugged away, right, at it with discipline, right? So he was not a trader, okay? He was not trading. He was not going in and out of his positions, right? He just plugged away with discipline, acquiring more ownership of productive assets despite multiple wars, inflation, deflation, numerous changes in the tax code, and the threat of nuclear annihilation, right? It didn't matter, right? He just, in fact, what's interesting is that when stocks go down, people tend to panic and they tend to sell. But that is actually the right time to buy. That's actually time to, of course, knowing you have to know what you're buying, right? But if you manage your finances well, and if you are able to control your emotions, right? Because when the markets crash, people become very scared, and they make a lot of bad financial decisions, right, out of fear, right? Because remember, markets move between fear and greed. Okay, so it's like a pendulum. So fear, greed, right? In other words, slumps, right? When the markets crash. And when the markets crash, there is fear, and when the markets are booming, there's greed, right? So it's basically the markets tend to move between booms and slumps, and as do the public's emotions, which basically fluctuates between fear and greed. So we have to basically learn to control ourselves, to control our emotions when the markets are fluctuating in such a way, right? And they will continue to fluctuate in such a way, right? That's just hard facts, right? There was this interesting saying. I forget who said, but it was I forget who it was, but it was the saying was something along the lines of if it was something along the lines of I can. This was very intelligent gentleman that said this. He said that. I can predict what the stars are going to do, but human emotions are something which are totally unpredictable, right? Something along those lines. Now, this is not the exact quote, but that was the gist of it, right? Because the point being that humans tend to behave very irrationally when they are overtaken by strong emotions, right? Like strong emotions like greed and fear, right? So anyway, coming back to the topic. And of course, we're discussing how Ronald Read got so rich. Now, it's very important to understand that Ronald was not just dabbling in stocks. He basically used to study stocks, right? And he only bought ownership in businesses he knew and understood through first-hand experience. Okay, so that's something which is also very important. You need to know what you're investing in. This is probably going to be another video that I'm going to make in itself, but this is something which is very important to know, right? You need to only buy ownership in business that you understand, and because the problem is if you before I go to that, do not invest on tips, right? That's something which is very important to know. If a tip is basically where I come to you and I say so and so company is going to go up in price and you should buy it, and let's say you know nothing about it and you invest in it, then that's you venturing into dangerous waters, right? Because what's going to happen if the market crashes, right? And and remember, when the tide goes down, everything goes down with it, right? Even in other words, even very good stocks, their prices will decline during a bear market, right? Everything goes down, or tends to, right? Almost everything will go down, right? So you need to know what you're investing in, because that's the way to build up your conviction, right? If you have studied the stock, because it's something very interesting. I heard Warren Buffett say this. I've heard him say this on many occasions, that that whenever the markets crash, right, and there are always people who are going to come up and say, and you'll see this. I'm not going to name anyone, but if you look around social media, you'll find so many people who are saying, this time Buffett is wrong. So they criticize him every time, but he just, and he gets a lot of criticism, because even the shares that he's bought, they also tend to go down, and and by the way, he's also mentioned on many occasions during his Berkshire annual meetings that he and Charlie, his vice chairman, they have seen their the Berkshire stock portfolio go down 50% or more, at least three times, right, over their lifetimes, with investment lifetimes, right? So that's big declines. But it's coming back to the point, when people used to criticize Warren for making these for being wrong, when the markets crashed, because remember, his stocks also went down. But he used to say that he did not lose a night's sleep, because he would just go and look at his numbers. Because point being that he had studied those businesses, he could see that the businesses that he invested in, the stocks that he invested in, the underlying businesses were doing very well, or they were doing relatively well, and there was no reason for. In other words, the point being that the markets were mispricing. The markets were making a mistake in pricing those assets, right? Just because the fear had, because remember what happens during a slump or an economic downturn or in a stock market slump is that fear basically takes over, and even very good businesses are going to start trading at lower multiples, right? So that's basically what happens. Now, so basically, he also, another important thing is that he only bought ownership in businesses that paid him a dividend, so he could physically see the check arrive in the mail, okay, which he would then deposit and use to buy more shares. The goal being growing his stream of monthly passive income. Now, this is another thing which is very interesting, and I've personally experienced this myself. Is basically, when again, this is going back to the same point where this also applies when the markets crash. And let's say you have a stock, you have two stocks, one which is paying dividends and the other which is not. Chances are high that even if fear takes over, right? If you tend to act irrationally during such times, what's going to happen is that, at least this is what I've observed in my own case. as well as quite a few other people as well that I know, is that the dividend paying stocks, the ones that are still paying good dividends, right? Because remember, during economic downturns, not all companies' performance is going to go down, right? Remember, some companies, of course, many companies are going to be affected to some extent or the other, right? In the case of an economic downturn, right? But not all companies are affected in the same way. Although their stock prices will decline significantly, but their economic performance or the underlying business has not declined as much, right? So in other words, the market tends to, it's coming back to the same point, that the market tends to misprice the market will tend to misprice those investments or those businesses, right? And that is the best time to take advantage of such opportunities, right? In other words, when the markets crash and that a business is doing really, really well, you just need to bag the truck up and just load up, right? So that's another thing. Now, another important thing in the article that was mentioned was he was like the super rich Vanguard client John Bogle discusses, who buy individual stocks and never sell a damn thing, right? They buy and they never sell, but so basically buy and hold. He largely he largely avoided turnover with multi-decade holding periods. Okay. He was not going in and out of positions. He would buy and hold and just hold. And in fact, he would, most of the time, he would keep adding those positions. This guy was a true buy and hold investor. Okay. Now, in my experience, something which is very interesting. If you ask people if they are buy and hold investors, and most of them, they will say yes, they are. But if you look at their statements, their broker statements, that's going to tell you something different. Okay, that story is going to be totally different, right? It's very difficult to be a buy and hold investor. I must admit, I still struggle with it sometimes. When the markets crash, I tend to because remember, we all need to take control, or we need to be disciplined with our investing, especially in the and we need something which is very interesting, which I've heard Warren Buffett say, is that basically investing is does not require a lot of IQ, but it requires a strong gut, right? In other words, what he's saying is that you need to be able to control your emotions, right? Because let's say you bought something you've got your portfolio is, let's say, $100,000, and the markets crash, and now the market is your brokers, your screen, it's on the screen, it's saying that your portfolio is now priced at, let's say, $48,000. You've seen a 50% plus decline, and that is when you are going to be tested, right? It's very difficult to do, but it's critical that we do that. We need to be patient when this happens, right? So this guy was a true buy and hold investor. He understood the danger of activity, right? Activity is like, buying, selling, like high frequency, having a lot of turnover. That base, because it results in fees. Every time you buy and sell, you are going to have what's called frictional cost, right? It's basically and if you keep doing it over the years, that's going to compound as well, right? So it's not a good idea to that's not good for your financial health, right? Now, he understood the danger of activity, the advantage of deferred taxes, and wealth destroying nature of high fees, what we just discussed, right? Now, another important point is that he grasped the math of diversification, because he continued to hang on to his shares even if the business went total bankruptcy, right? For example, he held a stake in Lehman Brothers, which was wiped out in the Great Recession in 2008 and 2009. Okay, remember, it's not necessary that all the 100% of your investment decisions are going to end up being good investments, or they're not going to pan out the way you expected them to. But even then, that's okay. Something which is very interesting is basically I was listening to this investor by the name of very, very interesting gentleman by the name of Monish Paparai. He's called Warren Buffett of India. He's managing around. He started with $1 million, when he sold one of his tech companies, and he was he started when he sold the company. He decided to go into investing because he came across Warren Buffett and Charlie Munger, and he heard them, and he became intrigued by their line of work, and he decided to go into investing. And in just 3 years, he started with his own $1 million. He in like 2-3 years he had 13 million. And a few years ago I heard he was managing around $1 billion in assets under management. Right? He had his own hedge fund kind of a thing. So that was I heard Monish say that and by the way, Monish was knew Warren Buffett and Charlie Munger personally, right? So Monish, I heard in one of his lectures that he in one of his talks he was talking about how Warren had told Monish that he had made approximately over his investing career about 200 or 300. I think it was 200 or 300, something along those lines, investment decisions, out of which just the majority of the results that he got out of those 200 decisions over the investment careers was basically that though just 10 or 12 of those decisions had resulted in the majority of the total returns, right? In other words, right? So a very, very small portion of the total investment decisions were actually massive home runs, right? The rest of them, some of them were okay, some of them were good but not too good, some of them were mediocre, some of them were even poor decisions, right? And still they ended up with we all know how much money they have today, right? So it's something which is something which you need to remember, is that that the investment decisions that we're going to make, not all of them are going to pan out the way we expect them to, right? And that's okay. That's totally okay, right? So continuing with this, he relied on an intelligently constructed, diversified, representative list of common stocks that was arranged in such the inevitable losses were swamped by the growth and income of the other holdings, right? So so that's exactly the point. He's saying that if even if some of his positions were losing out, the other positions were doing so well that they made up for those losses and then some, right? So that's basically it. I know the video's gotten pretty long, but I hope you found the underlying message to be interesting. I think I'm going to end the video here. And by the way, I'll call this my secret. I call these my secret millionaire studies, right? And I will comment in the comment section below. Let me know if you found this to be interesting, and I will share more with you guys in the coming future, in the near future, right? So I hope you guys have had a good time listening to this to my short rant. But I also hope that you got some good value out of it. And that's basically it for now. I'm going to see you guys in the next one. Take care. Bye for now.